Hello viewers, welcome to my channel. I'm Hasham. In this unit number 4, already I have completed 3 videos on sources of long-term finance. So totally 9 sources I have explained in the last 3 videos. The next topic in this chapter is regarding capital structure. So this theory is also very important. They may ask an examination, what is the importance of capital structure? What do you mean by capital structure? These things I am going to explain in this video. So remember, in the subject of financial management for BBA, theory is also very important. You should not underestimate. You cannot ignore the theoretical part, because in examination you may get theory questions also. So if you have not watched my theory videos, I suggest you go to the playlist of my channel. Select the subject financial management for BBA. Select the videos of sources, long-term sources of finance. Be perfect about that, then we can be able to understand this capital structure. So before proceeding, take the screenshot of the points which I have written on the board, then I'll explain. So every business organization needs funds. Long-term funds and short-term funds are required for smoothly running and maintaining the business. So we have seen the short-term funds are required for working capital management. For current assets, we need short-term, whereas long-term and for long-term source of finance is required for purchasing the fixed assets and for permanent working capital. So different sources are there from which the business can be able to procure the short-term funds and long-term funds. So if you see the balance sheet of a company, of a business, you can see the liability side will have equity share capital, preference share capital, reserves and surplus, debentures, long-term loans, any other long-term source of finance, apart from that current liabilities. All these are the sources of funds which are applied in the business. So the structure, this complete structure of short-term and long-term finances will impact the profitability, liquidity and solvency of the business. A proper capital structure is required to increase the profitability and also to survive in the long run. And it will help. The proper or optimum capital structure will help in attaining the objectives of the business. The objective is to maximize the wealth of the shareholders. That's why it is necessary. It is very significant decision for the management to make proper working capital, proper capital structure. Now, first of all, introduction to capital structure. So just now I explained you about the introduction to capital structure. Capital structure consists of all the long-term sources of funds, whether it is owner's fund as well as borrowed fund completely. So combination, no business can depend only on one source of finance. Different source of finances will be used, like equity, preference, debentures, bank loan. A proper structure is needed. That is necessary to attain the objective of the business. Secondly, meaning and definition. Meaning of capital structure. Actually, capital structure means the combination of long-term funds. In other words, the proper combination of owner's fund and borrowed fund, debt fund. The combination of shareholders fund and debt fund is called capital structure. There should be proper combination. The term capital structure refers to proportion of combination of the shareholders fund and debt fund. So what definition says? It is the combination of shareholders fund and debt fund. That combination is called capital structure. Shareholders fund include. What does shareholders fund includes? It includes equity share capital, retained earnings, reserves. And apart from that, whereas debt fund consists of debentures and long-term loans and other long-term sources. So debt means the debentures, long-term loans or any other long-term source. These are called debt fund. Whereas shareholders fund consists of equity share capital, preference share capital, debentures. Regarding preference share capital, normally it will be taken under shareholders fund, but under certain circumstances, like debt equity ratio, so normally we will consider this preference share capital also as debt. So normally it is considered as shareholders fund, but sometimes under certain circumstances, preference share capital will be considered as debt. Now, capital structure refers to the mix of long-term sources of funds such as debentures, long-term debts, preference share capital and equity share capital, including reserves and retained earnings. This combination of all the long-term funds, mix of all long-term funds, is called capital structure. So I have explained you about the introduction and meaning. Now, financial structure versus capital structure. There is slight difference between these two concepts of financial structure and capital structure. Financial structure means the equity share capital plus all long-term debts, non-current liabilities as well as current liabilities. So the complete liability side of the balance sheet is called financial structure. It's a wide concept. It includes capital structure and current liabilities. The current liabilities are also included in financial structure, whereas capital structure excludes current liabilities. If we will not include current liability in capital structure, it considers only shareholders fund and debt fund, long-term sources of debt. That's it. That is the difference between financial structure and capital structure. In examination, very frequently you will get a theory question regarding importance of capital structure. It's very important to have a proper combination of debt and equity. Otherwise, it will affect the profitability, the liquidity, and the long-term solvency of the business. That's why it's a strategic managerial decision to make proper combination, to make optimum capital structure. So how it is important, now one by one point I am going to explain. So my suggestion to my viewers, always keep a notebook, calculator, pen ready while watching the video, while listening the lecture. Whenever I say a very important point, note it down. Apart from that, you already have taken the screenshot. From that screenshot, you can get the complete notes which I have written on the board. So remember, theory, the concept should be very much clear. So first of all, maximization of returns. Returns in the sense income or profit. Every business, every company wants to maximize the returns, maximize the profit. So by making a proper capital structure, the returns will get maximized. In simple words, we can say financial leverage or trading on equity. These two terms mean same, trading on equity or financial leverage. What does it mean? By having a content of debt, it will lever means uplift the profitability. Because the rate of interest on borrowed fund will normally less. The cost of capital of borrowed fund will be normally less. So by introducing some debt content, the profitability will increase. The earnings per share of the company will increase. That shows the importance. So if a company depends only on equity, only on owner's fund, that means they don't have the financial leverage. The company cannot be able to increase the income, profit. So by making some input of debt, the profitability will increase. That is the reason why every company will have some debt content in the form of debentures, bank loan, or any other long-term debt source. Secondly, indicators of risk profile of the firm. The capital structure shows the risk. The risky capital is the borrowed fund. Why it is risky? Because whether the business earns profit or incur loss, the business has to pay interest on debt. That's why it is risky. So if a business is having more debt content, it shows that it is more risky. Less debt content, less risky. So whenever a person wants to invest in a company, the investor, potential investor wants to see what is the risk in the business. So this capital structure will show the risk profile of the company, how much risky it is. Next one is maximization of the value of the firm. When the profitability increases, when the liquidity position is good, when the solvency is excellent, then definitely the market value of the firm will also increase. The market price of share will increase. Everybody will put a positive point on the company. That's why in this way, the market value of the company will increase if we have a proper capital structure. Next one is minimization of cost of capital. See, normally the cost of capital is more for equity. The highest rate of return given to equity shareholder will be more compared to the cost of debt. Normally the interest rate, suppose the interest rate on debt is, let it be 15%. That means the rate of return to shareholders will be 30%. So normally 30% is the rate of dividend paid to shareholders, whereas debt rate, the interest rate is only 15%. So by having some debt content in the capital structure, the weighted average cost of capital will decrease. The overall cost of capital will decrease. So every business will have an objective of minimizing the cost of capital. When cost of capital is minimized, then it will maximize the wealth of the shareholders. That's why proper capital structure is needed to minimize the cost of capital. Next one, efficient utilization of funds. When we have a proper capital structure, we can be able to change the debt content. Equity share cannot be changed because we cannot be able to redeem the equity shares. Whereas in case of debt content like loans, according to the requirement of the business, we can keep the loan. If there is overcapitalization, we can repay the loan. If it is undercapitalization, we can borrow. In this way, it is more flexible. We can effectively utilize the funds, whether the funds are owner's fund or debt fund. Then solvency or liquidity position. If there is no proper control on the capital structure, if there is unplanned capital structure, then what will happen? The interest to be paid is a compulsory obligation. Whether the business earns more profit or business incur loss, interest have to be paid. This will affect the liquidity and solvency of the business. So if we keep a proper capital structure, optimum capital structure, we can be able to maintain the liquidity and solvency. Next, provides flexibility. If proper capital structure is maintained, we can be able to change according to the requirement. It's more flexible because some form of funds can be increased or decreased according to the need of the business. For example, excessive funds are there, we can repay back the loans. Suppose if there is further requirement of funds, we can borrow the funds. So in this way, the capital structure will be more flexible if we make a planned capital structure. Minimization of financial risk. When we maintain a proper capital structure, the financial risk will be minimized. Otherwise, if we make unplanned capital structure, there is always the risk that the company business may become bankrupt. The company cannot be able to service the debt obligations. The payment of interest or repayment of loan cannot be done. So always there is a financial risk if there is unplanned capital structure. So planning, proper decision making of capital structure is very, very important. Next one is tax planning tool. Nowadays every business has to plan regarding the tax, because from tax point of view, some cost of capital will be allowed as reduction, some cost of capital will not be allowed. Example, dividend paid on equity shares and dividend paid on preference shares are not allowed as deduction in computing the income for tax purposes. Whereas interest paid on debentures or interest paid on bank loan will be allowed as deduction. If interest paid is allowed, by charging the interest in profit and loss account, the profit will come down, the tax liability will come down. That is the advantage in having debt content in the business. So from tax point of view also, we have to plan regarding the correct capital structure so that our tax liability should be minimum. Next, good image of the firm. If the capital structure is properly planned, optimum capital structure is maintained, then definitely the goodwill of the firm will increase in the market. In the market, the company's image will be very good. People will come forward to purchase the shares. Every stakeholder will come forward to attach with the company. Either the suppliers or bankers, everybody will put a goodwill on the company because the capital structure is properly balanced. So these points shows the importance of capital structure. So in this video, I have explained you the introduction and meaning of capital structure and importance of capital structure to the company. Why capital structure is important. In the next video, I'll explain about the factors affecting capital structure. That I will explain in the next video. So if you're satisfied, give a like to the video, share my channel among your friends, subscribe if you're not subscribed, and give the comment regarding from where you are watching the video, from which university you are pursuing your studies, your BBA, etc. I'm waiting for your comments. Inshallah, we'll continue our discussion on this capital structure in the next video.